Welcome to today's video, and today I have my green tea. My name is mangomonkey. In today's video I have two objectives. The first one is to convince you to buy a property because I'm a mortgage broker by trade. So it is in my interest for you to buy a property and get a home loan from me. Full disclosure, I'm very transparent. The second objective there is to give you my honest opinion about whether I personally think it is a good idea to buy a property in the current climate towards the end of 2020. So this year, the Australian government is throwing a bunch of money into the market. There's something called the quantitative easing, where the government essentially prints money and give it to the banks and maybe other corporations. I don't actually know too much how that works, so you probably should do your own research on the internet. But also they do a lot of other things as well. So you have seen that the mortgage rates now is below 2% with a lot of the banks for an occupied home loan. Some banks offer maybe something like 1.89% interest rate depending on how much deposit you have and things like that. But you get the gist, it's generally very cheap to borrow money these days. What does this do to property prices? Well, it pushes the price upwards because the mortgage repayment becomes a lot smaller. And also the borrowing capacity of the customer increases by a significant margin. To give you a bit of background, a few years ago, when a bank assesses a home loan application, the customer must have enough income to afford the home loan with a hypothetical interest rate of between 7% and 8% per annum. So back then, the actual interest rate was probably around 3% or 4%, but the benchmark interest rate that the banks use to assess borrowing power was around 7%. Now today, the actual interest rate is around 2%, and the benchmark rate is around 5%. So imagine if you go down from a 7% benchmark interest rate to a 5% benchmark interest rate, or even a bit lower than that, your borrowing power will naturally increase significantly. A lot of Australians think of buying a home as whether they can afford the repayment. They don't really look at the price. So as long as they can afford the repayment and they are able to get the money from the bank, then they will actually buy the property. Because more and more Australians are able to afford more and more expensive homes, property prices are going to go up. What's the next thing that's pushing property price upwards? There's a lot of stimulus on the market. I will try to put it on the screen because I have to do a little bit of research after the video, but quickly it's going to be the stamp duty waiver for first home buyers, which is already out there from a long time ago, but this year the maximum price actually was increased. So more expensive property is still exempt from stamp duty. And what this does is it reduces the savings requirement for first home buyers. So normally when you buy a home, you want to put ideally 20% deposit and the stamp duty, but usually at least maybe 8% deposit and the stamp duty. Sometimes can be 5% deposit and the stamp duty. So if the stamp duty is gone, then you only really need either a 5% deposit or 8% deposit, depending on the lender that you choose and your unique circumstances. In New South Wales, you do not need to pay stamp duty if you are a first-home buyer buying a brand new property priced at no more than $800,000, or if it is a second-hand property, the price must be no more than $650,000. There's also the $10,000 government grant for first home buyer if you buy a brand new property. The brand new property must be no more than $600,000, so that's not going to get you too much. But if it is a house and land package where you construct the house yourself using a builder, then you have up to $750,000 price cap for you to still receive the $10,000 first home owner grant. Apart from this first home owner grant, you also have the home builder grant. So this one is a $25,000 grant. Soon it's going to decrease to $15,000, but this is basically giving you money if you construct your own home that you live in. And this one doesn't even require you to be a first home buyer. You can be a second home buyer, but you have to be Australian citizens, whereas the previous grant allows you to be an Australian permanent visa holder, not necessarily a citizen. There's also this thing called the First Home Loan Deposit Scheme, and with this scheme, you're able to borrow and pay only a 5% deposit, and the bank doesn't need to charge you lender's mortgage insurance because the government acts as the insurance for free. You do have to be Australian citizens, not just permanent visa holders, but actual citizens of Australia. In Sydney, the maximum property price was $700,000 and now it's increased to $950,000, but it has to be a brand new property. Brand new property can be either an apartment that's off the plan and it's already completed, or it can also be a house and land package where you construct the house. So why do I think that it is a good idea to buy now? In fact, it's probably a great idea for most Australians. Two things, or maybe three things. So number one is that your borrowing power now is much bigger compared to a couple of years ago. And it's likely to be much bigger compared to 5 years later, when the interest rates have gone up. The key to getting wealthy is to start early. There are a lot of things that you can do when you are in your 20s, and a lot of things actually happen just through the power of compound interest, where you actually do not need to do anything. You just sit around and maybe play video games, and you suddenly get richer and richer every day because asset prices keep going up. So you want to make sure that you start having an asset early in your life. If you wait 5 years, firstly, you may miss out on 5 years of capital gains, capital appreciation, but also your borrowing power is likely to be a lot smaller, so the asset that you can purchase will be a lot smaller. If the asset that you can purchase is smaller, that means the future capital gain will be a lot smaller. So even though hypothetically, if the property price goes down between today and 5 years later, it is theoretically possible, not sure whether it will happen, but it is definitely possible for you to actually be better off if you buy a property today instead of 5 years later when it's a little bit cheaper. The reason is because 5 years later, the property that you can buy may need to be a lot cheaper, not just a bit cheaper, but a lot cheaper. So you cannot actually buy the same property 5 years later, even though you are able to buy that property today. As mentioned before, the banks actually add a bit of a buffer when they approve your home loan application. So if, let's say, 5 years later, the interest rate on the mortgage is 5%, they will probably assume that the interest rate may become 8% when you apply for the home loan. So you have to be able to afford the home loan at an interest rate of 8%, even though in practice the rate may not even reach 8% ever. So that was reason number one, reduction in borrowing capacity 5 years later. The reason number two is that at the moment you may have your deposit ready. So this depends on who you are. But I know a lot of people who cannot maintain a large amount of savings for a long period of time. I see people that have, let's say, $30,000 today, but that's after they have been saving for 1 year or more than 1 year, but they cannot keep this $30,000 for a long period of time. So oftentimes something ends up happening with this money. So they end up spending it to buy something, maybe to buy a car, to go on holiday, to maybe go to casino, I don't know, but the money often disappears suddenly. So you want to make sure you buy an asset while you still have a deposit. So you need at the very least 5% deposit. It's even better and you have more choices if you have 8% deposit. So if today you have 5% deposit based on the property that you want to buy, You want to start to explore the opportunity further to see if you can buy something today before the money disappears. And also 5 years later, you do not know whether the government will still have the stamp duty concession. They will probably still have it, and in fact, the government may actually abolish stamp duty altogether and convert that into land tax, but it's not confirmed, so there's always that small risk that the stamp duty concession will disappear and the conversion to land tax will not end up happening. The next reason is that even though there are a lot of talks about property going down in value from now onwards, you do not know this for sure. It's the same as it's similar to the share market as well. So in March, the share market went down significantly, but since then it's been on the way up. I've been waiting for another stock market crash, but it hasn't happened yet, and I've been waiting for almost one whole year since March. Now let's talk about what kind of property is the one that I would personally buy if I am a first-time buyer today. Looking to grow my wealth, I'm in my 20s, early 20s, looking to build up my nest egg and maybe become a millionaire one day. I'm a believer of the idea that the things which are difficult to get tend to be better compared to the things which are easy to get. If I look at different types of property, there are essentially a few different, levels of difficulties in purchasing the properties. So the hardest one to purchase, that's way up here, is established houses. So established houses are the houses you see on the streets. They are normally sold in an auction in Sydney these days, even now, and normally the price guide is a lot less than the price that the winning bidder ends up paying at the auction. So if you see a price guide of $1 million, the actual price that ends up winning the auction is probably something like 1.1, 1.2, or maybe even $1.3 million. So it's completely way off. So if you want to buy a house that's $1 million, you really want to look at listings that's maybe around $700,000. That will make sure that you are able to win the auction that you go to. And when you buy a house, you should be doing a building inspection report first before you go to the auction, because if you win, then it's buyers beware. You cannot actually back out of the purchase if you win the auction. So even if the building has structural issues, if it has termites and some other bad things about it, you still have to buy the building. Now you may spend something like maybe $500 to do this building inspection report. If you do not win the auction, if you go to 10 different auctions, you will have spent maybe something like $5,000. But because the most difficult things to buy are usually the best ones, I believe that houses are the best thing to buy if you are able to actually buy that, because it's likely to go up in value most quickly compared to others. But to be honest, the first property that I purchased was an off-the-plan apartment. That's actually one of the easiest things to buy, because basically what I had to do was to walk into the display suite, talk to the agent for a few minutes, and basically just sign the contract. There are hundreds of choices to choose from. There were essentially no competitors. I do not need to bid against anybody else. I can just choose what I want to buy and the transaction is done. There are some risks of buying off the plan, so I probably do not recommend that unless you have a lot of savings and you have a stable job and you prepare to take the risk that the building that ends up being built is a bit different to what you were initially promised on. What other things can you buy? What other properties can you buy? Well, there's this thing called the house and land package. So house and land package is where you essentially buy a block of land. There's nothing on it at the moment, it's empty. And then you engage a builder to actually build a house on the block of land. So this type of property purchase allows you to access some government incentives like the first home owner grant and the home builder grant, and also the 5% deposit loan, which is guaranteed by the government with no LMI insurance premium. This one is a little bit more difficult to buy, so, and also it is a house, so it's probably still a good buy. It's less good compared to established house because you tend to pay a premium if you buy a house and land package because it is brand new. It's like if you buy a car, it's normally a bit more expensive to buy a brand new car compared to buying a second-hand car. One of the things that you may need to be prepared to do is to be ripped off a little bit. I mean, I was ripped off by the property developer when I purchased my first property. But after I held it for around 7 years, I still ended up making a pretty decent return. My return on the equity, the cash outlay, was around 17% per annum. So that's actually better than a lot of the stock market investments. If you buy a house and land package, there will be a period of maybe around a year where you will need to pay two accommodation expenses. One is your rental expense for you to live in during the construction period because the house is not built already, and the second is the actual mortgage repayment. So you have to start paying a little bit of the mortgage. You have already purchased the land, so you have paid the money to the seller of the land, and you have started to pay a little bit to the builder. So the builder normally gets paid in stages. They get paid a certain percentage, maybe 10% at the start, and then after that maybe another 15%, and then a bit more and a bit more, and so on until the house is built. As you draw down the loan, your mortgage repayment becomes bigger. So for this reason, buying a house and land package may not be for everybody, because there will be a period of about a year where you need to essentially pay two lots of things. One is your rent and two is your mortgage. Now the third type of property that you can buy, by the way, there may be more types, but I'll just stop at 3. So this third type of property is an established apartment. So established apartment is basically an apartment unit that is already built. It's not off the plan, it's already built. You see it on the street. So this property is very easy to buy at the moment because there are a lot of apartment investors who are looking to offload their investment properties, because there are a lot of tenants who are moving back into their parents' homes. So a lot of rental properties are sitting empty at the moment, and also there's a bit of a trend in Australia at the moment for people to want to live in a house. So you actually see a lot of apartment prices being discounted, maybe 10%, 20%, or maybe even 30%. So now it's a very good time to buy an apartment without having to do much work at all, if you are flexible with what you buy. So the idea is for you to have an asset early in your life, in your 20s, to allow time to do their work and compound your net worth. Of course, property doesn't always go up, but usually it does go up if you wait long enough. So if I was in my early 20s, I would want to buy one property. So not 2, not 3, just one. So I think one property is enough to become a millionaire. Maybe 5 years later you can buy one more. But I want to buy my first property early. Even if I'm not sure whether the price will go up or will go down, I just want to have it as a bit of a insurance policy, because you never know, maybe the price goes up and I want to be in the ride. If I only have one property, it's not that risky even if the price goes down, because I know that my salary is enough to pay for the mortgage. So what's the worst that can happen? I will be stuck with the property that I live in. I need to live somewhere anyway. I will be stuck with a mortgage that I need to pay every month. I need to pay rent anyway if I don't have the mortgage. I will be stuck in a property that loses value. While if I rent, I don't even have a property. So it's basically the same thing. Maybe one day my property value goes to zero. If my property value goes to zero, I look at my mortgage payment. Maybe it's a little bit more compared to my rent payment. Today it's potentially actually a bit less, but let's say it's a bit more. I haven't really lost a lot, have I? The alternative is I will be renting. So even if I buy a property today and the value goes down completely to zero, if I compare that situation to the renting situation, I'm not too much worse off. And if the property value goes up, I will be so much better off. So what do you think, guys? Have I convinced you enough to buy one property within the next 12 months? Or would you rather wait a bit longer until the price drops further? I mean, the price will probably drop, but it's very hard to pick the bottom. Sometimes it makes more sense to be invested in the market compared to being out of the market trying to pick the bottom and then you miss the bottom because you're sleeping when it is there. If you think you gained something from this video, please remember to hit the like button and share this with one friend. I also welcome donations from you, so I have a Patreon account that I have just created. If you feel like I help you gain wealth, build wealth, then of course I wouldn't refuse your donation. Thank you. If you want to get my help to get a home loan, please do reach out to me. My email should be on the screen somewhere. You can leave a comment if it's not there and I will reach out to you. Thank you for watching and thank you for your donation.